Every government says the same thing. We owe more than ever. The numbers keep rising. Trillions on top of trillions. Debts so large, they can never, ever be repaid. And yet, the system doesn't collapse. Markets keep growing. Banks keep lending. Governments keep spending. Money keeps moving. Here's the paradox that almost nobody stops to question. If debt is never fully paid, why does the system still grow? In any normal household, unpayable debt leads to bankruptcy. In any normal business, it leads to collapse. But at the global level, unpayable debt seems to be the fuel, not the failure. So today, we're going to pull apart this mystery, slowly and carefully, because the answer isn't simple. And the deeper you go, the more uncomfortable it becomes. By the end of this video, you may realize that debt was never meant to be paid at all. For most of human history, debt was dangerous. In ancient civilizations, rulers regularly forgave debt. Why? Because societies learned the hard way that excessive debt led to unrest, revolutions, and collapsed empires. In Mesopotamia, debt jubilees were common. In ancient Rome, debt crises triggered riots and political reform. Debt was seen as a destabilizing force, something that had to be periodically erased to keep society functioning. So what changed? The answer begins when debt stopped being a social relationship and became a financial product. That shift didn't happen overnight. It happened gradually, through banks, empires, wars, and eventually, central banking. The modern debt system really begins in early European banking. Banks realized something revolutionary. They didn't need to lend existing money. Through a system called fractional reserve banking, banks could create new money simply by issuing loans, while keeping only a fraction of deposits in reserve. Every loan created an asset for the bank, a liability for the borrower, and new money in the economy. This is the first key insight. Debt doesn't use money, it creates Italiano. From that moment on, economic growth became mathematically tied to debt expansion. Governments noticed this too. Wars were expensive, and taxes were unpopular. Debt was the perfect solution. By borrowing from banks, governments could fund wars, build infrastructure, and expand their empires without immediate backlash from their citizens. But borrowing had a side effect. Interest. And interest introduced a quiet, mathematical problem that no one wanted to confront. Here's the part most people never hear. When money is created as debt, only the principal is created, not the interest. That means the system always owes more money than actually exists. Think about that for a second. If every dollar in existence was created through a loan, and every loan requires interest, where does the money to pay the interest come from? It can only come from more loans. This means someone must eventually default, or new debt must be created to pay off the old debt plus its interest. So the system faces a choice: collapse through a chain reaction of defaults, or grow continuously through new debt. Collapse is politically and socially dangerous. Nobody wants that. Growth, on the other hand, sounds good. So the system chooses growth every single time. This is why debt never gets paid down. It can't be. Paying off all debt would literally destroy the money supply and cause the entire economy to grind to a halt. By the 20th century, debt was no longer seen as a risk. It became policy. After the Great Depression, governments learned a new lesson. When debt contracts, economies crash. So central banks were empowered to do whatever it takes to encourage more borrowing. They lower interest rates. They inject liquidity into the system, all to make sure the debt machine keeps running. Then came the final transformation. In 1971, the gold standard was abandoned. Money was no longer tied to anything physical. From that moment on, money became pure accounting, and accounting can grow forever. Debt was no longer limited by gold, silver, or savings. It was only limited by confidence. As long as people believe the numbers on the screen mean something, the game can continue. Normally, systems reset. Bad debts are cleared. Bubbles burst, and excesses are punished. But our modern financial system has stopped allowing full resets. Every time the system reaches a breaking point, like in 1987, 2000, 2008, or 2020, the response is exactly the same. More debt, lower rates, and bigger bailouts. Losses are socialized, meaning taxpayers foot the bill, while gains are protected for a select few. Instead of clearing bad debt, it's just rolled forward into the future. This creates a dangerous illusion. The system looks stable, but only because the pressure is constantly being deferred. This process of debt growth isn't neutral. It shifts power. Those closest to the money creation benefit first. Banks, governments, and large institutions. New money enters the system at the top and trickles down, but by the time it reaches the bottom, prices have already gone up. This is why asset prices for things like stocks and real estate explode, while wages seem to lag behind. It's why inequality grows. Debt-fueled growth doesn't lift everyone equally. It rewards leverage, it punishes savings, and it traps those who arrive late to the party. And the more the system grows, the harder it becomes for anyone to exit. Every crisis produces calls for reform. We get new rules, new oversight, and new promises. But these reforms never touch the core issue, that money is created as interest-bearing debt. As long as that remains true, growth requires borrowing, stability requires expansion, and debt must always rise. Even attempts to reduce debt are doomed to fail. Because reducing debt means reducing the amount of money in the economy, which leads to a recession. So instead of solving the problem, the system just manages perception. The numbers get bigger, the time horizons get longer, and the language gets softer. Deficits become stimulus. Printing money becomes quantitative easing. The underlying mechanism stays exactly the same. Today, global debt exceeds global production many times over. Governments openly admit that debt will never be repaid, only managed. Interest rates can't rise too high without causing a collapse, but they can't stay too low without creating massive distortions and bubbles. So the system walks a tightrope. Growth continues, not because the system is healthy and debt is shrinking, but because the creation of new debt is expanding faster than the threat of collapse. This is the final illusion. Growth doesn't mean health. In T-system, growth means dependency. So, why does the system still grow if the debt never gets paid? Because growth is no longer optional. Growth is required to service the interest on existing debt, to prevent mass defaults, and to maintain confidence in the entire system. The system isn't growing despite the debt. It's growing because of it. Debt is the engine. Growth is the exhaust. Let's boil this down to three main takeaways. First, debt was never meant to be paid. It was meant to circulate and expand. Second, economic growth is no longer primarily about creating prosperity, but about maintaining stability. And third, the longer the system avoids small resets, the larger and more severe the eventual consequences will be. History shows us something unsettling. Systems built on endless expansion eventually meet their physical, social, or political limits. The question isn't if this cycle changes, but how it changes, and who ultimately pays the price. Because when debt can no longer grow, something else has to give. If this video challenged the way you think about money, debt, and growth, subscribe for more deep dives into the hidden mechanics of global finance. And ask yourself one final question. If the debt never gets paid, what exactly are we all working for?